And we're live. How you doing, friends? This is the 0 Days to Expiration podcast, and this is where we go over all aspects of zero DTE trading our way, which is a extreme asymmetry or extreme risk to reward, trying to find convexity in trades, and with the goal of getting the best possible risk-adjusted returns that we can, and taking advantage of those unique opportunities that come with trading zero DTE options, particularly on the SPX. And today we're going to talk about volume profile, using it for our entries, trying to find the entry event. And this is a show that you're definitely not going to want to miss, and it's something that you're going to want to share with your friends and save in your watch list, because it is going to be so impactful, not only for zero DTE trading, but virtually every trade that you take in any strategy. Trust me on this. This is true. All right. So what are we here for? Say it with me, the mantra. We're here to make you consistently profitable, independent, and trade like a pro, or trade at a pro level. There is no other reason for these shows. There's no other reason for my service, my coaching service, which you'll find at FlyOnTheWall.ai. And if you'd like to join it, go there, become an observer, 4-week trial. You'll never look back. Today, we're going to do what is perhaps the single most important, if not the only worthwhile indicator, if you want to call it an indicator, for your trading. I don't use any of the oscillators. I don't use moving average. I do use one moving average, but I don't use it in the traditional sense. I use it very lightly. In fact, I don't even need the moving average. However, volume profile is the truth. What do I mean by it's the truth? Really, what do I mean by volume profile is the truth? You don't like the side view? This is not the good side of my face? James is saying, no, we need the center on view. All right, hold on. We'll switch it here. There, how's that? Beauteous. Volume profile is the truth, my friends. And I've been working with volume profile before it was even called volume profile. There was a precursor to that was called market profile. It is something that, and I worked with the originators of that as well. So I was a student of this from very early on. Back in the late teens, early to mid to late teens, I ran a course on volume profile, and most of the people that took it were Bitcoin users. And that's actually where it started to develop its weightiness, I think, and largely because of the people that I taught. I taught thousands of people that were Bitcoin traders on using volume profile to discover levels to get in on. And so it's been a long time. I've been working with it for well over a decade. And what I'm going to show you is very different from the way most people traditionally teach volume profile. Most practitioners are focused on the near-term profile. And sometimes they'll go and they'll look at a few days, maybe a week back or whatever, not realizing what volume profile actually is. It is a historical account of where the market has found value and where it has not found value, and all the lines of demarcation where those boundaries exist, the battle lines. It is so important. And it's the history, the entire history of volume profile that makes it impactful to make present day decisions. Not just present day, it is prescient. You can discover or already plan out, create scenarios based on that past history because it's going to be impactful today. And that's because the market has memory. And that memory plays out to the present day. So volume profile is not only going to show you where support and resistance are, structural levels, but also how price tends to behave within and between those levels. based on liquidity and based on the liquidity friction, the affinity that price has towards those levels, or the rejection. It's where consolidation and trending occur. It's everything to your trading. I can't say enough about it. So that's why this particular show is so important. And we're going to use it. I'm going to show you today how we use it to do our entries for 0 DTE out of the money butterflies, which are typically taken in the morning session. Now, it's just one strategy that can use volume profile, but it is our key strategy. I use the word key way too much. I noticed that in listening to some of so I'm going to try to suppress the word key. It's just easy to say. Come up with another word, Ernie. All right, so on to it. Oh, by the way, we do these shows every Monday, Tuesday, and Wednesday mornings on YouTube, simulcast on X at 9:15 a.m. So we'll be going right into the open in a few minutes. And every day I prepare a presentation for you that I will put the link in the description. It's not there right now, but it will be there after I do the show. I put a link to the presentation, and so you can go back and you can get all the presentations and put them together. It will be a master class in options trading and particularly with 0 DTE trading. And that'll go on and on. You'll get a whole library of what is essentially a master class in 0 DTE and options trading and everything that revolves around it. All right. So what we're going to do now is we're going to bring up the presentation. Where's Mr. PowerPoint? There we go. All right. And switch to it. By the way, if you're online and you want to ask a question, just go to the comments, ask that question. I'd be happy to entertain it. All right. There we go. Wow, first try. All right, this is why we're here. Mastering volume profile for 0 DTE entries. And I want to say right up front that the traditional way is looking at point of control, the POC, value area high, value area low, those type of things. Those are misnomers. They are lies. If you're following that, you are following a lie. It's as simple as that. So shed that, listen to this, find out the real truth, find out how a professional trader, how institutions are reading volume profile. That's key. And so today, yes, we're going to find out why POC is for fools. We're going to look at true structure and decode it. We're going to look at market memory and how we use volume profile to take that into account. Now, market memory is an important concept because the profile, while it is a historical account of where traders have traded, it is also a map to where they're trading now because that market has memory. It transcends and continues on. The nodes that get created persist over time, and not just in a day or a week, but in months, years, and even decades. That is why volume profile is so important. Every institutional trader, every market maker, every dealer, they're all watching the profile. They are establishing their levels. Pro traders aren't interested in your technical analysis. They're interested in one thing: levels, liquidity. Where they can get in, where they can get out, where they can make a stand, where they find value, where they don't find value. When it's time to search for value, price discovery. Everything happens around the profile. Everything. There's no exception. This is the way the market works. Have I made that impression on you strongly enough? All right. I hope so, because that is the truth. Volume profile is the truth. And look, if you like these presentations, give it a thumbs up. I'd like to see those thumbs up. Subscribe and share this video with your friends. They'll love you for it. All right. Next slide. We already went over this. Point of control, value area high, value area low are, when I say magic levels, what I really mean by that is that they are arbitrary, and people put value on them where it doesn't exist. What's more important is what I'm about to show you. The profile is the residue of intent. Oh, I like that. Forgot that I said that. That's another way of looking at it. It's really the edges of your high value nodes and those deep crevices inside the profile. Let me just go to a profile just to show you what I'm talking about. We'll go to TradingView. TradingView, by the way, in my view, is the best tool for viewing volume profile. All right, so we have a profile here, but that's not what I want to show you. I want to show you a full picture. We'll go to a daily chart and look at the big deal. And we'll hide all the markup. All right, it's coming. There it is. There's the profile. So we're looking at 3 years of data here, over 3 years. And you can see the market has gone all over the place. It's in a big, huge uptrend, as it always is, with requisite pullbacks and so forth. So all of this retracement, every time the market goes up, it establishes the profile. When it retraces, all of these nodes and deep crevices here, or the in between the nodes, they don't go away. They don't change. The initial node that gets created on first pass is typically the node that will exist forever, no matter how much the price replays over there or comes back. And that is super important. Like I said, market memory. Now, market memory, if you don't understand this, let me just say that this is the subject of intense study, academic study, and some of the greatest mathematicians in the world have written papers on system memory and market memory. In particular, go back and look at Benoit Mandelbrot, and he's the father of fractal geometry and all that, and fractals, and made it popular for us all. But he is also the person who has identified where market memory is so prescient and important. And so go back, look at Benoit Mandelbrot. Most of this market memory style stuff is really based on his work. So it's rooted in deep mathematics and behavioral sciences. So you'll see we have nodes, big nodes, small nodes, nodes within nodes, and what people call high-value nodes or HVNs, and then the absence of nodes. And a lot of people call these LVNs or low-value nodes. But in my book, I call them volume wells because they're not really nodes. They're more like the antinode or the absence of a node. So I call them volume wells. And what most people don't pay attention to are those deep crevices. Every single one of these deep crevices is super important. There's a reason why they're there. They're there because the market has universally, millions of traders, institutions, and so forth have decided that level, for whatever reason, is a no-go. And so what do you think happens when price encounters one of those levels? Just think about it. There's a reason why. And that's because your market makers, your dealers, your institutions are all lining up above and below those levels and defending them or skipping them. They have decided, for instance, that this deep area right here has no value to them in the market. Why? It doesn't matter why. It's just the matter that it is. And that's why it should matter to you. The market has decided there's very little value there, and so they tend to skip through it. That's why there is no profile. That's why the market isn't hanging out there. Where does it hang out? Where has it found value? It has found value in the node itself. Super important. And you'll notice that even inside of a big node like this, there are all of these what I might call child nodes, and each of those have crevices in them as well. And they persist. They'll persist over time. Sure, we've gone through this since the beginning of the year and gone back and forth through it, but those nodes and those levels and those crevices haven't changed. And if we were to, God forbid, pull all the way back down to these levels that we experienced in late 2024 and 2025, those nodes and those levels will persist as well. In fact, they will become our future roadmap, and so on. Extremely important that you understand. That is the seminal point here. Volume profile is the truth. Let's see, Jerome's asking, can you explain TOS settings to get equivalent volume profile in Thinkorswim? I would, except that I would say that TOS's implementation of volume profile sucks. I don't say that lightly. It totally blows. And if you're using TOS for your volume profile, I would say it's just such a poor implementation. Why would you do it? use the best tool, and that's TradingView, by far. I mean, there used to be other tools that were better, but they don't exist anymore, like Market Profile or Market Delta, which was a fantastic tool that I used, which was really a professional tool. And then for whatever reason, it was bought up by some other brokerage and no longer exists for the public. That was, in fact, the best market profile, volume profile tool in existence, but it doesn't exist anymore. TradingView picked up the tab there and has implemented a lot of what was in Market Delta. It is by far the best tool. And if you're going to be putting your money at risk, why would you use a substandard tool like Volume Profile on Thinkorswim? I can't imagine why you would put your money, your hard-earned dollars, at risk with a substandard tool just because it's there and it's free and you don't want to spend the, $200 a year cost for TradingView. I'm not getting anything for you going to TradingView. I'm just telling you that's what you need to use. You got it? Good. Let's see. Fight says, as a quant developer, will you recommend scripting your own market profile study? Yeah. What do you want? So anyways, let me continue. I don't want to skip any of this. It's super important. Let's get to the presentation again. There we go. All right. Next slide. Let's look at the basics of volume profile. We have high value nodes, which are called HVNs. We have low value nodes, or LVNs, which I call volume wells. I think that's a far more appropriate name. And then we have these deep crevices, which I showed you on the real profile. They're typically inside the well, but they can also be inside of a node as well. And that's really super important, and we'll get into that in more detail. And as I said, I distinguish the two as high-value nodes and volume wells, and then the crevices in each one of them. Now, my goal is to mark up the profile in its full history, right? That's so important. And what I'm really marking up are the edges and the crevices. They're all establishing levels. These are structural levels. This is the market structure. This is where the line of demarcation is for traders, for institutions. This is where their orders are lining up on the edges of those nodes and on those deep crevices. And that's what's going to cause support and resistance. You'll also find that if you're a study of gamma exposure, or the GEX, that this is where typically those gamma walls are all lining up as well, on those edges of nodes and those deep crevices. You can think of the GEX as the volume profile in real time. I've explained it like a swarm of honeybees. The GEX is like the swarm of honeybees just doing their busy work, right? All over the place, and they're concentrating on particular areas. Really tough to discern exactly what they're doing. You can see them lining up, and then when they leave behind the structure, the honeycomb, that's the volume profile. That is probably the best analogy that I can come up with, the difference between the GEX and the volume profile. They are intricately related. One is real time, the other one is the aftermath. But the aftermath determines where they're going to go in real time. That's the conundrum. That's the reality, and that's your advantage. So it's where price has already proved what it cares about. The recent high-value nodes from prior sessions are incredibly important. They will persist not only over the last session, but the last week, the last month, the last year, the last decade. It's where the dealers were pinned last week. Sure. Everything about this, you need to be a study or a student of volume profile. Examine not only the structure of it, but also the behavior of price as it traverses the profile. And it's a lot easier when you start doing the structural markup and identify the levels. And once you see it, by the way, once you see it, you can't unsee it. All right. Next. We're not going to I touched on dealer gravity and the GEX, but we'll talk about that in a separate, more detailed show, maybe later, maybe next week. All right. Again, this is all part of that discussion. and also volatility regimes has somewhat to do. Now, yesterday I talked somewhat about volatility regimes. That's all part of our preparation in the morning, where we're looking up. We have to decide where we're trading, what the current situation is, the energies that are coming into the market, the volatility regimes to determine our width, and so forth. All of that has been covered in the previous episodes, so go back and check that out. But there's overlap here, so that's why I include it, including what type of trade that we're putting on. We're putting on asymmetric trades, and our rule is that we never pay more than 10% of the width of that fly. We're pushing it out of the money to get that extreme risk to reward, 1 to 9. And where we place it in the profile, I'm leading up to that. We're going to show you how we actually identify the structural levels. That'll become a structural event, and when that event occurs on a particular time frame, then we'll place one of these trades that abide by these rules that have been set out. And again, if you're not familiar with those, I have a full series of presentations that I've been doing over the past couple of months. Talk all about it. Put them all together. You're going to have, like I said, a masterclass. Hey, Ernie, is there a difference between market maker and a dealer, or is it the same? I would call it the same or similar. I talk about market makers, dealers, institutional traders. They're the big guys, but they have different priorities. Market maker, dealer is really all about keeping delta neutral and creating liquidity in the market, making a market. That's why they're called market makers. Institutions are following their own edict, right? They don't have the fiduciary responsibility of a market maker. They're out there to try to kill you. However, it's very important they're watching what the market makers are doing, all right? Let's see. We'll move on here. We're going to move on to the good stuff now. Our checklist. We want to mark up our levels. We want to confirm market memory. Yes, we want to check convexity and the GAX and volatility regime, etc., and price our fly. Those are all part of it. But these first two is really where we're at, and that's what we're going to be concentrating on. So when I mark up the volume profile, here's an important concept. I cannot mark up the volume profile in a short-term chart. It is irrelevant. That's because I'm getting more noise than signal. I need to get as much information as I possibly can of the profile before I mark it up. So what I need to do first of all is figure out the trading range that I'm interested in analyzing. So now we're at all-time highs. So I would say from where the all-time high is down below maybe 300 points or so. If we had retraced and we're somewhat in the middle of a large retracement and there's lots of history behind me, then I'll probably go 300 points above and 300 points below, and then I'll go all the way to the left, and I want to make sure that I'm showing and displaying that profile for all of the price action that has ever happened within that price range. Extremely important. As I said, the market has memory, and getting all of the profile history is absolutely important. And if you're not, then you're cheating yourself. You're not getting the full picture. Right? Now, I said that as price goes up and down and over, and those nodes tend to stay, they do, they keep on repeating, but repeated retracement over those areas is going to make them a little bit more mature. And so this is an exacting science. Sometimes one level can change from, say, 7,200 down to 7185 or 90. It might change as much as 5 points, but it's going to be approximately in that same area. However, you want to make sure that you have exactly where the market now is establishing that level. It will stay within 1% of where it was originally cast. It's just like our own brains. We have long-term memory, medium-term memory, and short-term memory, and each one of them are working on and reinforcing the other. It's the same way with profile. The long-term memory doesn't change. It's just that we might get more clarity as we go over it or revisit it. So when I mark up, I have a particular style and system that I use because we're doing the markup in a big picture of the profile. So let me just bring up the profile so that I can demonstrate this. All right, so I'm hiding it right now, and I'll just bring it forward. All right, so you can see up here, I have all of this markup up here in different colors that you'll see, and I'll explain all of that. But my main goal is that we're near all-time highs, so I'm trying to get all of the profile within that area. And as you can see, as I said, it's about 300-400 points from where I am down below. If I were down here, then I would be marking up 300 above and 300 below. And that would mean that I would be looking back to include all the profile all the way back. So right now I don't have to go very far back. I only have to go back to here in order to get or establish where I want to mark up. That's the only thing that's important. But if price were down here, then I would want the profile that goes all the way back to here so that I can see the full profile as I'm marking it up. In other words, I use visible range profile on TradingView, which, by the way, Swim doesn't have. And that's one of the big differences. And it doesn't really mark it up exactly where you want it. You can't get the same level of granularity you can on TradingView, also on Thinkorswim. All right, so that's why it's important that you understand this and that you get the full history involved. Now we're, like I said, in all-time highs, so there's not as much that I have to deal with. So I am going to zoom in to that area that I need. And I can do that by just dragging the calendar bar. And then because I am in that viewable range version of volume profile, it'll change or adjust or auto fit the profile so I get the best view of that profile. All right, so I'm going to just move it over a little bit more and then do it again. I don't really need it all the way out here. Sorry, I should have prepared this. There we go. All right, that's about all the profile that I really need. That the volume profile is redrawing every time I do that. Let's get rid of the profile. Oh, I'm sorry, that box. All right, so here's the detail that I need in order to draw the volume profile. Now notice a couple of things. I have gotten rid of value area high and value area low. That's the thing that would demarcate the one standard deviation around the most volume in that chart. Totally irrelevant. I've gotten rid of point of control. Again, totally irrelevant. I've gotten rid of up and down volume. Again, totally irrelevant. I've made everything one single monochromic color so that I can see the profile as best I possibly can. And the other thing I've done is I've created the finest level of granularity. I want to get, say, 1 tick per row if possible. If you have a much higher resolution machine or monitor, like I do, I have a 6K monitor here, you can do that. If you don't have that, then choose 1,000 or 2,000 rows to display. In any case, you want to get the highest resolution possible so you can see those structural edges. Very important. So once I can see all of that, I can even expand it here by dragging in here. Then I can start marking it up. And my methodology really is to put red lines at the bottom of nodes, or the top of nodes, and green lines at the bottom of nodes, and then yellow lines in between nodes, marking up the deep crevices. If you look very carefully, you'll see that I've marked up these. Here, we'll bring it in here, make it a little bit more. So you can see here I've put a red line on the top of this node, a green line on the bottom of this node, and then blue lines in crevices inside the nodes. And then when I get to all-time highs, we haven't really established nodes yet. We're starting to. So if I were to put a red and a green line here, I would make this one the green line, like this. I typically will make those nodes those lines a little bit thicker so I can identify them very quickly, and make this one the top of the node. I'm just guessing. It hasn't really developed yet. It probably will, but that's the one that I would make red and a little thicker. And then the lines in between or inside of a node, I always make those blue. But when I'm at all-time highs, I will typically make them all yellow until I have established whether or not they're inside or outside of a node. But this is how I do it. So now I have my deep crevices, other features that I've seen that I believe are impactful, or where the market makers and dealers and institutions are lining up. And then I mark it all up so that when I go to now this is a daily chart. So when I go to my 5-minute chart and I auto-fit it, I can see exactly where all those lines are. Now at this point, I don't need the volume profile anymore. So I simply remove it. The other thing that you'll find that I do is I mark up the sessions. So here I've just compressed the calendar scale so you can see all the different days that I have been analyzing. And now I can see exactly where the nodes are. So I can tell right now, for instance, that there is a node right here, because here's the bottom of the node and here's the top of the node. And I can see also that these are the crevices intranode. And notice how market is following exactly along those lines. This is what I'm talking about. All right. All of that, super important to note. The vertical lines are showing me where the market sessions are. I break it up into morning, afternoon, and closing session. Morning session for me is 9:30 to 12:30 Eastern. Afternoon is 12:30 to 2:30, and then 2:30 to close, or 4 p.m. I'm most interested in entries in the morning session. Why? Because that's when we have the most volatility and the most movement. Plus, that's where I can get ahead of the start of most moves. Not always, but usually. And you'll see here, I've identified areas on this day where I thought it might pull back to. Now, it ended up that we pulled back early on right here, and that would have established a tradable event, which would have been right there. And so we would have put on a out-of-the-money call fly because we're in a bullish trend, and we would have taken that trade and we would have profited. Now, it just so happens that it turned around after that, but after that point, we're out of the trade. We're done for the day. We've made our money, made good money, and it's moved against us. You might say, why don't you trade that? I don't know. I don't have any real edge to play on there. If I had another strategy that wasn't our 0DTE looking at the morning session volatility, then I would probably trade that, but I don't. And you say, oh, you're missing opportunity. Okay, great. But you can argue all you want with me, or am I arguing with myself? But these are arguments that I've heard. I'm looking for setups that have the highest level of probability, and I trade those. And you do that, and you're going to make good money. You're going to have awesome risk-adjusted returns. In other words, you're going to be super efficient on your trades. You're going to spend the least amount of money for the maximum amount of return. That is what we're after. We're not after every single trade. We're after the ones that make us whole and make that bottom left, top right equity curve. That is what we're after. Now, we do have other strategies that look at gamma scalping and so forth that might be more appropriate for these types of moves, but we're not talking about that right now. We're talking about using volume profile for getting an entry to a 0DTE out of the money butterfly trade. Very specific, all right? So if you understand that, click that like button. Let's see it so that you're cool with that. And if you want to learn more about those other intraday trades, I'd be happy to talk about them, but that's not the subject that we're talking about today. And so you can see the next day, I picked this area here. Now, all of these lines were chosen pre-market. And so there was another tradable event, and this one actually ended up being quite a large trade, probably close, not maybe inside the profit tent, but not a pin. And it stayed up there for most of the tradable day, and that would have resulted in very large profit. Same thing happened over here. Never really reached this here, this level. It could also be that I maybe missed a line. I can see clearly that there has been some activity right at that level, but for whatever reason, I didn't mark it up. And that's typical when we get up to all-time highs. The liquidity is low. We're just establishing some of these nodes, and so you don't get all of the detail in here. And it's a little tougher to trade all-time highs. All right, Russ is saying, good morning. How you doing, Russ? What criteria do you use to determine the edges of the HVNs, especially it has smaller nodes in between them and the crevices? It's a visual thing, but one way that I make it easier, when I create the profile, I make sure that it extends almost the entire width of the chart, so it elongates the nodes. And then what I do when I'm placing one of these lines, I'll demonstrate here. We'll go back to a daily chart and then add the node. And I'll just bring it down to something that we can all look at, and I'll demonstrate exactly what I do. If I were to draw a line and try to identify a crevice, I usually start with the crevices, by the way. I find the deepest crevice and try to place my line right over that hits that one level. You can see how thin these lines are right here. I want to capture that. And then I place my line there. Now that's in between a node, so I would want that to be yellow, right? And so then I'll go along and I'll mark up all the crevices first. And so clearly I can see one there, here, and so on, right? They're really easy to pick off. Then I look at these nodes, and what I try to do is find the line that covers the most of that long edge from blue to black. So, for instance, let's pick off this node right here. I will just find right about there. You can clearly see that line will cover most of that, even though it's not perfectly straight. And that's not necessary. I just need to. Now that's the top of a node, so I would color that red and maybe make it a little bit thicker. And so then I do the same thing on the bottom of the node. I would try to find the line that covers the vast majority of it, maybe right there, and make that green. So that's really the technique. When I'm inside of a node, I will find other features. In here, there's a feature where it's clear that they've established another level. I would make that blue. So there's a deep crevice right there. And so I would make that blue there. So now I've established all the different types of structural lines that I would have created. Are you looking for entries on 5-minute time frame? Yes, I'm looking for entries on 5-minute time frame, but I am not marking up on 5-minute time frame. I'm only marking up on the big time frame so that I can get all of the necessary volume in line so that I can establish exactly where those are. And then I zoom in to 5-minute, and I will then remove the volume profile because what's left back is my structural analysis. So after I've done all of my markup, then I'll go back to my 5-minute chart or 3-minute chart, whatever you like. I'll typically bring in a few days. I like to get in a few days. And this morning, we can see exactly where we had a tradable event right here, right on that level. See that? Right there. Yesterday, we had right here on that level. It hung out there for a while, hit it many times before it decided to go up. But it wouldn't matter. If you got in here or here, it wouldn't matter because by the end of the day, it would have been moving into your profit tent or near your profit tent or in the tradable area, and you would have been able to extract a trade, a profit. So this morning, we hit it right here at this structural level. It pulled back and immediately went up. But that's where we would have been triggered for that tradable event. Now, that doesn't mean we put the butterfly right there. Remember, we're putting out of the money butterflies with a specific width and risk to reward that we have already predetermined. Go back to previous episodes. We've already predetermined where and what it is, how wide it is, whether it's a call or a put fly, above or below the market, and what's the risk to reward that we're going to play. Typically 10% of the width or less, maybe as little as 5% of the width. So that's between 1 to 9 and 1 to 18 risk to reward. And so when we get a tradable event, we already know what kind of fly we're putting on. And so we would put it up here somewhere, wherever those criteria would meet our criteria, right? So I know how wide I'm going and how much I'm paying. So all I need to do is find that fly above there at the time that this event happens. This is a timing event. Now, you notice that it's on the ES. Could you please show your TV settings, volume profile. Yes. All right. So here are my inputs. Right here I'm using number of rows and how many rows that I'm using, 1,500 rows. Another valid way to do it would be ticks per row and then make this a very small number like 1. Now I can do that on my chart because I have a very high resolution chart. You might not be able to do it on yours. But those are the two different ways I would do it. Number of rows, a very high number, 1,000, 1,500, 2,000, or ticks per row, a very low number, like 1 or 2, preferably 1. And then the other thing that I would do, make sure that volume is on total, not up and down. See, here's up and down gives you useless information. It's just noise. You do not care. You want that on total. And the value area volume, this is what establishes value area high and value area low. I do not want to see it. And the only way to eliminate it is to make this 100%. So it takes in all of the profile. Typically, it will be set to 70. And what that does is it colorizes and makes everything outside of 70% of the volume a darker color. And what they're trying to tell you is that those levels have significance. And I'm here to tell you that they have 0 significance. All right, so make that 100. So that's your inputs. Now let's look at style. For style, just choose a color that you like. And that's under value area up. I could change the opacity, but I like to keep it a little transparent so that I can easily see price behind it. The other thing is I turn off my POC. I turn off my value area low and value area high because they're insignificant, irrelevant. All right. I don't want to see developing. I don't want to see any of this noise on here. And I also want the width to be as wide as possible so it takes up the full width here so that I can elongate these edges, making them easier to identify. All right, James is wondering, how do you prevent choosing an entry event that touches structure and a false breakout? There are a lot of ways, and we're going to go over that in another episode. But let's say that you can use the GEX, you can use divergences, you can use price action. There are a lot of ways that you can do that, or you can just use your intuition when it hits a level and you see a pattern that you recognize and you think that it has found support. That's a structural event. But you can use more technical ways to do that as well. And if you miss and it goes down to another level, that's okay. You've taken very, very little risk for that trade. And if it goes down to another level and establishes that as the structural event, then take another trade. It's okay, as long as the second trade keeps you under your maximum position size, and you're okay. Missing is not a problem, James. It's not the end of the world. You might have a second or even a third chance at it, and maybe all 3 of those trades will end up profitable, or they'll all be losses. If they're all losses, it's still under your maximum position size, which is set to a level that is very small. So even if you had a sequence of 10 huge losers to your max position size in a row, you would still be within our drawdown limits. So don't sweat the idea of being wrong is part of this game. The thing is, you want to be wrong in the least amount of way possible. In other words, you want to be the best possible loser. You be the best possible loser and you're going to be a massive winner. So don't sweat missing a level. Do your best. Over time, you're going to start developing a much stronger way of determining whether it's a level that you should pay attention to, a structural event, or maybe you should hold off. That's the key. See, I use that word. I can't get away from key. Say it too much. All right, so there's my setup. I don't need the profile, by the way, in this time frame. So I turn it off. All I care about now are the levels and the session. And so I've already demonstrated exactly how I go about that. I find that structure. Now, here's the thing. I'm doing this on the ES, and I'm actually trading the SPX. And so a lot of people will say, how do I know what level on the SPX? You don't have to know. All you have to know is when the event happens. because your next move after the event happens is to enter a trade. And he said, how do I know what level to put the trade on? Again, you don't need to know what level. You're going in there with two pieces of information that are going to determine the level. So the width, and you know how much you want to pay for it. That's all you need to know. So those two pieces of information, the width and how much you're going to pay, will determine what strikes are going to be used. And of course, in our fly on the wall application, we have a convexity heat map that shows you exactly how much you want to pay and where those convexity points are. You can select a butterfly immediately. I don't know if I have it up and running here. Let me just see. Yeah, I do. All right. Let me demonstrate. Just give me a second here. So this is how we would do it with fly on the wall. Let me get this up and running. All right. So here's our risk graph on the right. We don't have a trade yet. On the left, we have our convexity heat map that has the entire options chain. This middle line here is spot. Let's say that we've determined that right now is a tradable event. And so I want to go and choose a fly. I already know, maybe I've predetermined that I want to do a 30 wide fly because that's what my prep told me. And I already know that I don't want to pay more than 10% of the 30 wide. That means I can't pay more than $3. So it's $3 or less. So what I do is I go over here, right here, and I see my 30 wide column, and I see where $3 starts. Here's one for $3.66. Here's one for $2.80. So the $2.80 is the closest. But look at this. One more tile out, I can pay almost $1 less. Now it's changed. It's changing all the time, by the way. But this one is clearly less. So I have my choice. Do I want to choose this fly or this fly? This is the center strike of the fly. So let's say we choose this guy at 250. Actually, just as I chose it, it went to 278. So there's my fly, 30 wide. Click the analyze. There it is. There's my trade. That's simple. So that has placed my trade based on the tradable event above the market with the width that I want and with the risk to reward. If I want to send that to my Thinkorswim, I can just go here and copy it and then paste it right into my Thinkorswim, and I'm done. No fooling around, no trying to find the right trade and size it and everything. That can take minutes and often get you out of sync with the market and maybe miss the opportunity. Here, you go into fly on the wall, you find it, you know exactly what you want to select it, and why you're selecting it, and all the other trades around it that are also possible selections, which you can't possibly do in Thinkorswim or any other trading platform when you're in the options chain. But here, you can do it in an instant. Save you 90% of your time, get the best trade, and you'll know why you're putting the trade on. I'm making a play for our fly on the wall service, because not only will you have the benefit of having coaching every day, and a Discord with hundreds of like-minded traders that have been trading this strategy for years, but you'll also be able to ask me questions directly. And if you're a part of our Navigator service, you'll have a live stream every day, every single day, where you'll get coaching, direct coaching. All right? So that's the benefit of joining Fly on the Wall. So go down below, click FlyOnTheWall.ai/try, become an observer. You'll have full access to this tool, as well as our Discord and coaching. You won't regret it. All right. So I'm in that trade. Now I'm hoping that it goes towards me and bounces off that structural level. Now we can already see that if we go back to the chart, that would have happened and we would have been in a trade. We would have taken it down here and it would have moved towards us, and we would probably be at about 150% profit on the risk that we would have taken. So already right there, I'm showing you a setup where we would be in profit right now. Same thing happened here. Not so sure about this day, which would have been last Friday, but Thursday for sure. And I can go back and I can show you most days you're going to find these types of tradable events and successful trades. Most days, but half the days. But the days that we don't find a tradable event, or we put on a trade and it doesn't work out, the risk is super small. Super, super small. And the days that it does work out, the return that we get is often multiple times of the risk that we would take. That's it. That's the nugget that you're going after. You're after small losses, large potential wins. That's what makes us asymmetric traders. Now, there's a lot more to it, and there's a lot more to finding and being more deterministic on when you actually discover a tradable event, which trade is best for you. Do you choose the one that's for $2.50, $2.70, or the one that's for $2? You're going to find over time that the ones that are further out of the money and wider are better for you. And that may seem counterintuitive because it's going to push it further from the money when you first get in. But you'll find that they will have the best risk-adjusted returns, and it will make you a lot more money and result in much smaller drawdowns. But that's something that you have to develop over time. Yeah, this is one of those coaching moments, so I'm going to go back to the big head here. Let me just say this, that trading in a fast-paced environment with something like 0DTE, where optionality is changing minute by minute, price is moving all over the place, it's a dynamic trade, you're in a dynamic position, you're trying to decide once you get in whether to hold or fold, and you need to follow the strategy, the process, the methods. But that takes practice, fundamentals, discipline. It takes guidance from the coach. Make sure that you're doing the same thing over and over. Once you've established that pattern of discipline, this becomes easier and easier, and your profit making becomes more regular. And then you become consistently profitable. And once you understand why you're taking those trades, you start becoming independent. Maybe you don't need the coach as much as anymore. Maybe every once in a while you get off base and you need the coach to slap you upside the head and get you back on base. All right? But over time, as you develop these routines, these habits, and you become expert at each of the individual fundamental things that comprise these habits, you start realizing, and you're journaling and logging and then using that as a continuous improvement loop to look back at your previous performance and see where you are and identify the areas that need work and those that are good. That's where you start developing that level of professionalism. So again, those are the three things that we're after: make you consistently profitable, independent, and trade at a professional level. That's what we're all about. And we're a little over today, but that's okay. Oh, no, actually about an hour in. So if anybody else has any other questions, I'd be happy to entertain it. If you don't, let's just say I hope you have a great trading day. Peace to you. Join FlyOnTheWall.ai. Love you all. Take care. Where's the close button? We'll see you on Monday.